I'm delighted to welcome Mirza Ali, Manager Actuarial, and Shruti Sahani, Senior Manager Actuarial, for their session, Reflection in the Rearview Mirror and the Way Forward. In this engaging session, they will share their reflections on the past experiences while offering valuable insights on the path ahead. Let's extend our warm welcome to Mirza and Shruti.
Okay, so what we are going to do, we're going to divide this session into two parts. We will be looking into the numbers which we have done for the pricing for this year at the beginning. Most of the companies were doing on the first quarter and second, so we'll cut it off until 2023. And then on the next part, Shruti will look after the things which happen, especially the climatic changes, flood, and every other events divided into different line of businesses. So let me start with the first session. So what I will going to cover in this session is we'll look into the business mix, tariffs, exposures, frequency severity, and then in the end the combined loss ratios for the market. Overall, currently as of now, the overall UAE insurance severity is at 30 billion, which is quite a growth from the last year, which was at 25 billion. This is some of the older 25 companies overall in the market. So we can see that if I look at the premium-wise for the comprehensive business, it more or less in a similar range, but it's quite growth from the 21 for 6-7%. But on the TP, we see a quite dip in the recent year from if I compare it to 21 on the premium-wise. And as far as the exposure-wise, right now, as of now, we are at a 50% proportion and the exposure mix if you look at in the current year. Business mix is still it's same for the last 3 years. And if you can look at the previous year as well, it mainly consists of the top 3 segments of the body type: saloon, 4x4, and pickup. This is for the comprehensive business. And now this one is the agency and non-agency mix for comprehensive. If you look at the increase in the agency part, this is mainly driven because of the new introduction of the new vehicles in the market. If I just put some numbers on it, that from 2021 to 2023, there's almost double the size that vehicles has been registered. It's 150,000 at the 2021, and now it's the 300,000 new vehicle registered by the RTA this year. And also, you can say that due to the increase in the prices of the old vehicles, because of the smart supply-demand issue, most of the customers are going towards the new vehicles. So that is also, and for the new vehicle, mostly they prefer the agency repair. So this is one of the reasons we are seeing an increase in the exposure of the agency one. Now, if you look at the TP, the business exposure mix is more or less similar as far as TP. So mostly saloon, 4x4, and pickups have the most exposure. Rest are very minimal. Okay, now looking at the tariffs, the average tariffs, if you look at quarterly or quarter-on-quarter changes on the tariff, from 2020 to 2021 and 2022, there was a slight dip we see, but now in 2023 from quarter 3 onwards, we have quarter 2, quarter 3 onwards, we see another spike going up. This is one of the main reasons why after the removal of the discount circular, this is one of the reasons that tariffs are going again up. Once we go later half of this presentation, we'll see how this impacting our overall loss ratios and for both of the segment TP or COM. So this is the main factor why we have seen the spike in the later half. Similar for the CP as well. Overall, for the last 1 year, if you see the average tariff is more or less consistent, but now still we are seeing a spike even more higher than the one we have in the 2020 year. So again, both CP and DP is morely impacted by the discount circular, which is the main cause of this spike. This is what I've done. I just taken few of the vehicle from the saloon. If you look at these dots are the burning costs, and this is minimum, maximum, and the mean medians for all the four or five vehicles. If you look at these two vehicles, this is Nissan Sunny, and this one is Nissan Ida. So both have the same sum assured. This is average sum assured. So both have the same sum assured, but if you look at the burning cost and the average tariff charge in the market is different. This is mainly because of the usage. Because mostly the Nissan Sunny is used in the rent-a-car and other these kind of services. So this is why. Sorry, driving schools. Yes. So this is one of the factors that we have the high burning cost, and the tariff is also high for these girls. So one of the main factors, which is the usage, which need to be incorporated in our pricing structure as well. So that's why we always emphasize on that. If you now look at to the 4x4, similarly, if you look at this, I will need to emphasize on the petrol, which is the last one, and this one is the Land Cruiser. So if we look at the average sum assured, both have the same in the similar rate, 5 to 10,000 difference on average sum assured. But again, the burning cost is higher of the petrol, and similarly comparative to that one, the average tariff charge is higher. Is again because of the more usage, more prominent vehicle in the market, and more popular vehicle. You can say that the status symbol. So that is one of the things. That's why, and if there's more exposure on the road, then there might be a possibility of having the high risks of these vehicles. So this is one thing. Now again, for breaking the agency non-agency into tariff, like we have already seen, the agency exposure is increasing. Similarly, we can see that this spike, and this is because of the two different reasons. One of the discount factor, and another is the increase in the agency exposure. Why this is increasing? We sub-segregated into the vehicle ages. Like if you look at the vehicle age-wise factor, in 2021 we have 13, and this is for one vehicle age, 0, 1, 2, 3, 4, 5 years, and on based on that exposure, it was 13% of the total in 2021, and now it moved to 26, almost double the exposure which we have. Similarly, you see the growth in almost every section. Apart from the fifth one, which is because these are the older vehicle and very lessly likely to have the agency repair for these segment. If I look at the average sum assured of the vehicle, as I said, that because of the less supply demand issue, older cars are now become more expensive than it was earlier. So if you look at the average sum assured, we have seen this is 0 to 1 year vehicles, 2, 3, almost every segment has spiked up from the 2021 year. So every sum assured is also getting increasing. So the rates have been impacted by one of this factor as well. So now jumping into some burning costs, let's say for TP, on average the burning cost exposure is on a similar range for the last 1 year, and burning cost is also. This is the cost, the risk cost for the vehicles is almost in the similar range. Okay, and similar for the CP as well. And if we go in further into the frequency severity side, this is also more or less in the similar range for the 1 year. There's no sudden spikes or something we can see like we have seen in the tariff. But what these frequency severity, stability, and the increase in the tariff impacting the overall loss ratios. If we look at the combined loss ratio for the TP, we haven't seen any such, and again, this is based on what portfolio we have, and there might be some differences in your personal portfolio, but this is because it contains with the mid-tier and the high-level tier, both companies. So it includes the claim management system as well, so that impact also. So for TP, we haven't seen there's such much difference between the impact of the tariff, but in CP, if we see in comprehensive, we have seen a reduction in the overall loss ratios from the last year, and that mainly driven with the increase in the tariff. Since if we look at the previous slide, then there's no sudden change in the frequency or severity part. So that is not because of that, okay, we have the low severity and high frequency in these here, but this is mainly driven from this one. So based on that, there are a few suggestions which I need to put. that we need to go further in the personalized pricing methodology, like we need to introduce more factor, like in other regions, we used to do pricing for more than 13 factors using this one. So like if we introduce vehicle age, license age, and other main factor that can personalize the pricing lecture, so that based on just because of increase in the agency, number of vehicle age, agency for the recent 0 to 1 age vehicles, we can manage that spike, and also we can manage our overall portfolio as well. Again, secondly, there should be like Saudi, there's a Najm over there, so we need to have a centralized data management system over here, so that we can collaborate with them and to make further adjustment on the pricing and other factors, like especially for the no claim discount, like the discount sector were revoked last year. So other than that, we should have the centralized database so that we can introduce a better discounting factor based on different sub-factors in the market. Pricing methodology, right now, IA is focusing every company to move towards a more sophisticated method like GLM. So that is one thing which need to be incorporated. And again, last thing, if we go like this by increasing the rates, we see this is same thing in the Saudi, that due to just a price war thing, most of the companies are still struggling to get them, their portfolio profitable. So we need to put some proper processes under, again, underwriting, so that we don't go into the price war like in either way. So it will not be beneficial for anyone. So these are the few market insights which I put on the screen and with some suggestion. So now for moving towards the next session, Shruti will go from here, take up from there for 2024 analysis. Thank you, everyone.
Good morning, everyone. Today, I'm presenting the growing impact of climate risk. Climate risk is no longer a distant challenge. It is a reality that is reshaping our world, and the impacts are increasingly visible on our businesses, economies, and lives in profound ways. Let's start by reflecting on how extreme weather events have become more frequent and intense in the GCC region. In 2018, Cyclone Mekunu caused heavy rain and damage in Oman and Yemen. In 2019, Cyclone Hika brought strong rainfall and flooding in Oman and parts of the UAE. In 2020, flash floods from heavy rains disrupted daily life in Fujairah and Oman. Cyclone Shaheen in 2021 caused massive flooding in Muscat and parts of UAE. In 2022, Fujairah and Jeddah faced flooding and waterlogging. Cyclone Tej struck Oman and Yemen in 2023, underscoring the vulnerability of coastal areas. In 2024, Dubai witnessed significant rainfall and severe flooding not once, but twice, in February and April, causing widespread disruption in one of the most modern cities in the world. A surreal reminder of climate unpredictability came when snowfall was recorded in Al Jauf, a desert region in Saudi Arabia. These events demonstrate how climate change is no longer about averages, it's about extremes. Now, let's think about the potential climate risk we might face in 2025. Considering the unique challenges in the GCC region, which event do you believe will have the biggest impact? The options are displayed on the screen. Please take a moment to share your thoughts. Okay, thank you for participating. Let's review the responses now and see where the collective focus lies. As expected, we are still we are still thinking that the cyclones and storm will be our next event that will happen. And the extreme heat waves that we also see in 2023. There was a record of 49 degrees Celsius recorded in July, which was a decade high in UAE. Yeah, okay. So we have already discussed about this presentation, this slide in our last year conference. I'm just gonna quickly summarize the key aspects of the climate risk and its implication. There are three types of climate risk. Physical risk are the direct effects on the infrastructure and resources from climate changes. These can be classified into two. One is acute, which are the sudden events like hurricanes, floods, and heat waves, as we have already seen in the UAE in recent years. Chronic risk are the general gradual changes, such as rising sea level and the higher temperatures. The next one is the transition risk. These emerges as we move to a low carbon economy. Then there are different types of transition risk. One is regulatory risk, which involves compliance with evolving policies, such as carbon taxes, emissions standards, or green energy mandates. Market risk stems from the shifting consumer demand toward the sustainable options, like electric vehicles or renewable energies. Technological risk related to outdated systems becoming absolute with advantages in green technologies. Reputational risk arises when organizations fail to meet environmental expectation and damaging trust. The last one is the liability risk. These risks arises from the legal claims or lawsuits related to the climate changes, such as failure to adapt or mitigate leads to operational and legal challenges, or inadequate reporting of climate risk or sustainability. With this foundation, let's focus on how recent events like the 2024 April rain has impacted the industry. April rainfall caused widespread disruption and significant damages across the region, creating a considerable challenge for the insurance industry. Such events underline the growing financial burden of climate-related risk, with insurance often shouldering the majority of the losses. Let's look at the overall impact. The severe flash flooding. The record-breaking rainstorm in April 2024 with 255 mm of rainfall compared to usual around 140 to 200 mm per year shows how climate change is making extreme weather more intense and frequent. The economic impact of this event was early estimated around millions of dollars in economic losses. Fires and floods caused extensive damages to homes, commercial buildings, and farmland, displacing families and crippling the agriculture sector. Transportation was heavily disrupted, with roads, the Dubai Metro, and the airports leading to canceled flights and highway closures. Damaged highways, closed bridges, and power and water outages further disrupted daily lives and businesses. This has led to a surge in claims, highlighting the urgent need for more resilient and tailored insurance products. Now, let's examine the April rain losses in relation to the total claims for the year-end 2023. So we saw the three major lines of business, which are fire, motor, and commercial. To explain the graph on the screen, the box plot represents the distribution of the ratios for the sample companies. The lower line of the box plot shows 25% of the companies have losses less than that corresponding percentage. And the top line shows the 75% of the companies have losses less than that corresponding percentage. Starting with the first graph, fire. The fire insurance claims were hit hard by the flood. Claims were on average 3 times higher than the total incurred claim of 2023. So the 3 days rain has already resulted in 3 times higher claims. Many companies reported closest to 5 times to the prior year's total. On the motor side, the motor insurance was more resilient to the rain and flooding. Claims increased by 0.3 times than the total claims of 2023. Even at the 75th percentile, the increase was modest at 0.5 times the total claims, indicating that the motor insurance was less affected by the flood compared to the fire or the property insurance. On the commercial, we saw that engineering line of business was the major driver of the rain losses. On an overall basis, the claim roses by 1.2 times than that of 2023 on average, with the 75th percentile showing 2.2 times increase. One thing to note is that on the net side, due to sufficient reinsurance, the impact on motor and commercial lines are less, whereas on fire, the impact is still high, which is around 107%. Moving forward, here's another Menti question for you to answer. How sufficient is your reinsurance coverage for absorbing multiple large-scale climate events in a single year? The options are again on the screen. Please take a moment to select the one that best represents your perspective. Okay, I think we have an answer. I think majority of the companies have adequate for most events, but assuming that we are not even forecasting the events that are still we think it's not possible, but will happen. And there are like few companies who think, I mean, like 38% of the companies are still think it's not sufficient. The next slide that we are talking about is the impact on equity. Yeah, sorry. So here we are analyzing the impact on equity of April rain losses, which has been calculated by the April rain claims for the 3 days by the P&C equity of year-end 2023. So on the graph, you can see that on the gross side, the average impact of April rain losses on 2023 equity is 48%, whereas 75% of the companies have less than 60% impact. On the net side, due to sufficient reinsurance coverage, the average impact is 4%, whereas the 75% of the companies have less than 6% impact. One major event has already significantly impacted the company's gross equity. If multiple catastrophic events were to happen simultaneously or in quick successions, it raises the question to whether the company would be able to absorb the financial impact, or it could lead to a potential solvency issue. While reinsurance has provided a crucial support to this instance, the increasing frequency and severity of climate-related risks are beginning to affect reinsurers as well, highlighting a broader concern. So as we face the growing reality of climate change, the insurance industry must take the proactive actions to adapt and create solutions that address emerging risks. It's no longer enough to rely on traditional models. We need to evolve. Let me outline some of the key strategies we must pursue. We need to focus on creating new insurance products that can handle the risk caused by the climate change. This means working closely with the regulators, consumers, and the company to design the product that meet these challenges, which clearly define the policy term to avoid any confusion. It is also important to educate everyone about the climate risk. We can do this by running campaigns to help people understand the impact of climate changes. To manage these risks, we need to measure them carefully by looking at the past claims to help us set the right prices for the coverages. Regular stress testing will also help us imagine extreme weather events and see how they could impact us. This way, we can ensure that our reserves and reinsurance plans are strong enough to handle future climate shocks. By taking these steps, we can protect both our businesses and the people we insure. As many companies were struggling to deal with the rising impact of climate risk, one of our clients saw an opportunity to stand out by offering protection for those who weren't covered under the extreme weather on their motor policies due to older vehicle. We worked closely with them to design and price this product, ensuring it would effectively address rain-related losses. This collaboration highlights how valuable is to offer specialized coverages. Not only does it help insurer better manage the risk losses, but it also provides customers with crucial protection in the climate that's becoming harder to predict. Then there are ways of how you integrate the climate risk. You have short-term approach where you need to quickly assess your current models that are capturing climate risk. For example, if your catastrophic models are underestimating the flood risk due to the outdated assumptions, we must adjust them to better reflect the reality of increasing extreme weather events. In medium term, over the 5 to 10 years, we'll dive deeper into the sensitivity testing using the new data to refine our risk models. In the long run, we will need to adopt a more strategic approach, which may involve reassessing our risk appetite, exposure, and stepping away from the areas that are increasingly insurable. At the same time, shifting our focus to emerging sectors with strong growth potential, such as those aligned with a low-carbon future, will be essential. Lastly, on the strategic actions, it is essential that we adapt our investment strategies to focus on sustainable, climate-resilient opportunities. By prioritizing investment like green bonds and renewable energies, we can align our capital with a more climate-positive future. At the same time, we have a responsibility to support organizations and government in strengthening their governance and climate risk management. We must also take an active role in disaster planning, advocating for updated building codes and resilience measures to help communities better withstand climate impact. And just as importantly, we need to be transparent about the steps we are taking to address climate risk, ensuring that our commitment to sustainability is clear and measurable. Together, these actions will help us build a more resilient and responsible future. Thank you.
Thank you, Mirza and Shruti, for your valuable insights.